Hi, today I want to talk about something that's quite interesting and personal to me. Obviously, it's my own blueprint, my own system that I've created to help business owners make more money, manage money, and ultimately make more profit. And if you look in front of me, it's one of the modules actually, and that module is called the Financial Risk Controller, which comes under one of my what I call gray areas of managing risk. And risk here, R-I-S-K here, actually are elements within that module. You see, and each of those letters R means something, I means something, S means something, K means something. And today I'm going to focus on the S. No, you might be guessing what it's about, but look, I'm just going to tell you it's your statements, financial statements. And financial statements are very important in business. It's not something that just your accountant should do and then you file it away and then until the next year comes around. Financial statements should be turned into something called your scorecard. Yep, into like metrics so you can make more informed decisions. Look, one of my mentors said, if you don't know the score, you don't know if you're winning. So if you can't read the scoreboard, you can't read the financial statements, how do you know if you're winning, right? And that's really why financial statements are very important. I'm going to go through one of the key financial statements today, conscious of time and just the purpose of this actually training. Some of it might be very basic for some of you, but I really want to show you the importance of understanding your statements. And then I want to show you a distinction between a business statement and a personal statement. So here we go. So we look at the balance sheet today. And the balance sheet, as most people will already know, is assets, liabilities, and capital, also called equity. And there's a formula which accountants use, which is say assets is equal to liabilities plus capital. Look, you can actually derive capital and say capital is assets minus liabilities. But importantly, what's happening here is that assets are what the business own. Liabilities are what the business owe, and the capital is really the monies that's due to the owners, the people who are actually taking the risk in the business. That's the capital, also called the equity. Now, let me give you an example here. But before I look at this example, let's tell you that the balance sheet is always at a point in time as obviously different to, let's say, for example, the profit and loss account, which is also called the income statement, which is also called the statement of income and gains. Accountants like to mix up, the different names for these different statements, just to keep you on your edge. But a balance sheet is a point in time, and bankers, lenders are really interested in your balance sheet because it really show the health of your business on an accumulative basis. It shows you, as at this point in time, what have you done up till that point in time. So if you look at the balance sheet, let's say as at the end of December 2019, it shows you where at you at a particular point in time, but it really gives a story of how have you been running your business. What do you own, what do you owe, and obviously what's your equity. Now, I'm not going to go through any of some of the numbers in any big extent, but I'm just going to show you this example. And here you can see that obviously what you own is what is used to actually create income. And that's really the definition of an asset in terms of a business. It's used to really generate income. Yeah. And it's something that you own, like your investment, your equipment, your receivables, etc. And that's tallied at 85K. And then your liability is what you owe. You owe someone that. Yeah, you owe the bank, you owe the creditors. The creditors are your customers who give you goods and credit. Yeah, um, you owe the payroll. Obviously it's a very simple balance sheet because if you really look at it in a more complex manner, you might have something called fixed assets versus current assets. Assets that are longer term and the duration. Current assets are kind of short term assets, which you can easily turn into cash, say within 6 months. To 3 months a year. And obviously, liabilities can be long term, which you owe that person for a period longer than a year. But I'm not complicating that now. I'm just saying this is a simple balance sheet just to give you a flavor of this. Now, you see, one of the important things here that some people actually mix up is to say, right, well, if I have a house, if I'm in business and I have a house, is it an asset? No, because this is from a business perspective. This is through the lens of the business. This is what the business owns. This has nothing to do with your personal assets and liabilities. And in business, you should really be keeping your personal assets divorced or separated from the business. And that's why you should be setting up something called a limited company. You limit the risk, yeah, that you have in terms of should the business go down, you only limit it to the amount of capital that you actually put in. So what's the capital in this scenario? Well, the capital in this scenario is 20 grand. As you can see for yourself, is 85. Take away 65 grand. Very simple maths. Now, this gets very complicated in financial services where I've spent most of my time. Because what you will then do is do something called asset liability management. You say, well, what is the duration of the assets? What the currency of the assets. And for example, is the duration of the assets and the duration of the liabilities matching? If there is a mismatch, there's some risk here. And if, for example, your investments, let's say, the average duration of your investments is, say, 5 years. In terms of you invest into long-term stuff, and the average duration of your loan is 2 years. If you're called upon to pay those loans immediately, you may not have the money. You may have to sell your equipment. You know what I'm saying? And that's why it's very important to make sure that your assets and liabilities are matched in terms of currency, in terms of duration. But that's a bit of a complexity I'm not going to really introduce here. This is just very much to show you at a very basic level what a balance sheet looks like. Very basic, very clean. Now let's look at this from a personal perspective. Yeah, personal perspective. We look at what is called your net worth, not so much what your capital is. I mean, obviously, if it's a house, yeah, we look at something called your equity. But importantly, from a personal perspective, you say, what is your net worth? What is it that you own versus what you owe? And that's why oftentimes many of the, if you want to call it, the gurus in this field, say like Robert Kiyosaki, etc., they will say to you, your house is not an asset because your house doesn't give you any income. But for the sake of this simple balance sheet again, I am going to include your residential home in terms of the value of the house. Yep. And I'm going to put the mortgage as well. So in this case, your equity in the house is 100K. But as we know, equity is dead money. And because the balance sheet changes daily, if the property market falls, therefore the equity falls. So equity is really dead money. Dead money because you cannot spend your equity unless you actually realize the equity. Unless you either remortgage and take the equity out, or you sell the house and realize the equity, you cannot spend equity. For example, in this particular scenario, you cannot use some of your equity to pay for your car PCP payment or pay off your loan. You have to know, you have to realize the equity, you have to release the equity. But look, on this simple balance sheet here, you're seeing that there's actually that person has a value in terms of the assets and the residential home, which is actually here in gray because it's very debatable if it's an asset, if something that you actually own. And that's why I put value rather than actually own. You can see here 535K versus 455K. Look, you can all work it out in terms of the net worth, yeah, and that person obviously have a net worth of 80K. But interestingly, if you remove the 100K equity, you have a negative net worth. You have more liabilities than you have in terms of assets. And that might be the case with a lot of people actually who have luxury cars, who have big cars, for example, and they don't have much investments. I said this is a very simple example. I just wanted to share this with you to just get up to speed with some of the thinking here. I mean, from a risk perspective, it's very important that your assets are always higher than your liabilities. And obviously, from a cash perspective, you want to always make sure you have enough cash to always meet your liability payments. But that's kind of covered more in one of the other statements I will cover in this series of training under your cash flow statement. I just wanted to just get us out there, very basic level. I'm likely to go down into much more in depth on this balance sheet. And this is just for now. I wanted to introduce to you my blueprint. I've been talking about it, I've been posting about it, and this is just from the financial risk controller module, only looking at S, only looking at balance sheet. There are three primary statements, and it's just looking at a high level. You know, I I can literally spend a whole day training just on S in this module. So you can see here that this blueprint. They call it profitable business blueprint or the lucrative business blueprint. There's various names for it. But importantly, is to help you manage your money, help you multiply your profits, and help you obviously invest in income generation assets. But look, thank you very much. It's for me, Royston, and you coming about just sharing this video, just changing up the kind of way I actually share content. So I wish you all the best, and I want to say to you, go out there and buy more assets in your business, but use those assets to make income. I will be sharing probably future series as well to show you how you can measure the efficiency of your assets. Thank you very much, and I'll speak to you soon. Bye bye.